Imagine this, you're earning solid returns on your portfolio, but when tax season rolls around, a big chunk of your gains disappear. Why? Taxes. Did you know that stocks, bonds, and mutual funds all follow different tax rules? If you don't understand how those rules work, you could pay more taxes than is really necessary. That's an important concept because it's not what you make, it's what you keep. More money in your pocket means more opportunity for growth. Don't invest in the IRS. Hi, I'm Keith Demetriades, and today we're talking about how taxes can cut into your investment returns and what you can do to hold on to more of your money. Let's start by taking a look at this case study from Fidelity. It offers a direct comparison of the taxation differences between stocks and bonds. On average, stocks deliver a 10.1% annual return before taxes. But after taxes, that drops to just 8.2%. That's a 20% loss. For bonds, however, the difference is really dramatic. A 5.2% pre-tax return shrinks to just 2.9% after taxes. A huge 40% reduction. Why such a big difference? It all comes down to how the tax code treats different types of income. Bonds pay interest, and that interest is taxed as ordinary income. That means it's lumped in with your paycheck, business earnings, or any other taxable income you've got. Depending on your tax bracket, that rate can be pretty steep. Now, stocks, they get a bit of a break. If you hold on to your stock for more than a year, any gains are taxed at the long-term capital gains rate, which is much lower than ordinary income tax. That's a big advantage right there. But there's another reason stocks tend to come out ahead. Volatility. Stocks go up and down much more than bonds. That might sound like a bad thing, but savvy investors use those fluctuations to their advantage with something called tax loss harvesting. By selling stocks that have taken a loss, you offset gains from stocks that have gone up, reducing your tax bill. So the rules for bonds and stocks couldn't be more different. It's critical to understand that there are different rules for different investments. And keeping that in mind, there are 3 things you can do to help lower your tax bill. 1, you can defer taxes. 2, you can manage taxes. And 3, you can reduce taxes. Let's talk about how each of these things work. If you're paying taxes on your investment earnings every year, you're slowing down your ability to grow wealth. Think of it like running a race while carrying a backpack full of rocks. You're making progress, but it's slower than it could be. Deferring taxes means setting those rocks aside so you can move faster. Instead of paying taxes on dividends, interest, and gains every year, you let your investments grow tax-deferred, meaning no taxes today. Then you pay later, when you might be in a lower tax bracket. So how do you make this happen? It's all about tax-deferred accounts like 401ks, IRAs, and even deferred annuities. Here's how you can use those things to your advantage. Max out employer plans. If your employer offers a 401k, a 403b, or a 457b, that's your starting line. Contribute as much as you can, especially if they match a portion of what you put in. It's like getting free money to grow, tax-deferred. Don't invest in the IRS. Consider opening a traditional IRA. If you have room in your budget, meet eligibility criteria like income level, filing status, and access to a workplace retirement plan, a traditional IRA provides another good tax-deferred option. Every dollar you contribute reduces your taxable income today while building your wealth for tomorrow. Take a look at deferred annuities. If you're already maxing out your employer plans and IRAs, deferred annuities could be a great next step. They're designed to let your investments grow tax-deferred for as long as you need. Matching the right investments to these accounts. This is where you can really get ahead. Tax-deferred accounts are perfect for things like bonds, high dividend stocks, and high turnover mutual funds. Why? Because these investments generate income, and by keeping them in a tax-deferred account, you don't have to pay taxes on that income until you actually take it out. That gives your money more time to grow without Uncle Sam stepping in too early. On the flip side, things like equity index funds, long-term stocks, and tax-managed mutual funds work better in taxable accounts. They're taxed at lower long-term capital gains rates, so they're already pretty efficient. Getting this right might seem small, but it makes a big difference in how much you keep in the long run. Remember, deferring taxes doesn't mean avoiding them altogether. You're just being strategic about when you pay. The longer you delay the tax man, the more time your money has to grow. Don't invest in the IRS. The second thing you should know is you can actively manage your taxes throughout the year. Things you do along the way can make a big difference when tax day arrives. Let me give you 5 strategies you might consider to reduce your tax burden and keep more of your hard-earned money working for you. Tax loss harvesting can make a big difference when it comes to your tax bill. Here's how it works. If some of your investments have lost value, you can sell them and use those losses to offset the gains from your profitable investments. For example, if you had $50,000 in gains but $30,000 in losses, you only owe taxes on the $20,000 difference. And if for some reason your losses exceed your gains, you can offset up to $3,000 of your regular income and carry the rest forward in future years. Here's a quick scenario to show you how that might work. Let's say Sarah has $12,000 in losses in her portfolio this year. Meanwhile, she has $5,000 in gains from other investments. Sarah can use the $5,000 of her losses to offset the gains. Meanwhile, she doesn't owe taxes on them. That still leaves her with $7,000 in losses, but she can apply $3,000 of those losses towards reducing her regular tax income this year. Then the remaining $4,000 in losses can be rolled over to future tax years, which can offset gains or reduce her ordinary income down the line. Obviously, no one wants to take a loss, but you can turn that loss into an opportunity to save. And remember, when it comes to capital gains, timing matters. Hold on to your investments for at least a year, and you'll pay lower long-term capital gain taxes instead of higher short-term rates. It's a simple way to keep more of your returns. Pay attention to fund distributions. Mutual funds can surprise you with taxable gains, even if you didn't sell anything. Those distributions are taxable, so keep an eye on when they happen. Buying after the distribution date can help you avoid an unnecessary tax bill. Be smart about rebalancing. It's important to keep your portfolio in line with your goals, but making adjustments in taxable accounts can create taxable events. If you do your rebalancing in tax-advantaged accounts, like your IRA or your 401k, you can adjust your portfolio without worrying about taxes. I'm not saying that you shouldn't rebalance in taxable accounts. If you're in a higher tax bracket, you might also consider adding municipal bonds to your portfolio. They offer free tax income at the federal level and sometimes at the state level, making them a smart option for generating steady, tax-efficient income. With those 5 strategies, you've got some great tools to help manage your tax burden and keep more of what you earn. But we're not done yet. So far, we've talked about 2 methods to reduce your tax bill. When you defer, you push taxes to a later date with the idea that you'll be in a lower tax bracket in retirement. And when you manage them, you focus on controlling when and how much you pay. And remember, don't invest in the IRS. That brings us to the third way you can lower your tax bill: reduce. This point is especially exciting because it involves strategies that cut your tax bill permanently, whether that's through tax-free accounts, charitable giving, or other tools that can make a lasting difference. Let's talk about some ways you can reduce your tax bill. Roth IRAs and Roth 401ks can be a powerful tool. Unlike traditional retirement accounts, contributions to Roth accounts are made with after-tax dollars. So your withdrawals in retirement, including all the growth, are completely tax-free. If you're in a lower tax bracket now than you expect to be later, it's a smart move to pay the taxes up front. With that being said, consider Roth conversions if you already have a traditional IRA or 401k. Why, you ask? Because this strategy lets you move money from a tax-deferred account to a Roth account, paying taxes now, yes, to enjoy tax-free growth later. It's especially effective in years when your income is lower than usual. Next, take a look at the health savings accounts, or HSAs. They're triple tax advantaged, making them one of the best tools out there. You get a tax deduction for contributions, you get tax-free growth, and you get tax-free withdrawals when used for qualified medical expenses. If you don't need to use the money right away, you can even let it grow for years and use it later in retirement. It's also important to consider how you will withdraw from your accounts in retirement. Tax-smart withdrawals are all about the sequence. By pulling from taxable accounts first, then tax-deferred accounts, and saving tax-free accounts like Roths last, you can reduce the taxes you owe over time. This strategy assures you make the most of each dollar you've saved. But there are also other specific situations where varying this withdrawal sequence makes a lot of sense. Consider investing in tax-free accounts for education. 529 college savings plans allow you to save for educational expenses with tax-free growth and withdrawals. If funding education for kids or grandkids is on your list, this is a great way to do it while minimizing taxes. And finally, charitable giving has a dual impact. Strategies like donating appreciated assets or setting up a donor-advised fund let you avoid capital gains taxes and still take a deduction for the fair market value of your donation. That in itself is great, but charitable giving is the ultimate win-win situation because you not only reduce your tax burden, you also provide support and create positive change for others. There's nothing better than knowing that your money is being used for impact. Well, there you have it. 3 ways to keep more of what you earn. You can defer, manage, and reduce. When you get smart about taxes, you give yourself the chance to build wealth more effectively. Every little bit you save adds up over time, and that can make a big difference. Don't invest in the IRS. I'm Keith Demetriades. If this video got you thinking about how taxes might affect your returns, or if you're wondering what steps you could take to save more, subscribe to my channel and hit that notification bell. There's more wealth building content on the way. And if you know someone who could benefit from this information, please share this video with others. Remember, be a savvy steward. Make your life count.